Welcome to Subscription Prescription, the podcast where you get the information you need to scale your subscription program. I do want to bring up an invisible problem that is plaguing subscription companies, and that is accidental churn. This is when an otherwise happy customer's legitimate payment is falsely declined by the credit card company, resulting in their subscription being canceled. There's a company that I'd like to introduce you to. They're a partner of this show and a sponsor of this episode called Butter Payments, and they focus on reducing accidental or involuntary churn and keeping customers around who want to be on your subscription. That's because the problem with involuntary churn is a lot of customers don't actually know that they are being canceled and they don't want to be canceled. Butter is able to automatically resolve those failed payments that otherwise would have led to churn and keep your recurring revenue and subscription customers as healthy as possible. I've got a link to their website in the show notes. So if involuntary churn, or if you're worried about those few percentage points you're losing every month because people are canceling and don't actually realize it, you should check them out. Welcome to another dose of Subscription Prescription, the podcast where we try to help you understand all things related to e-commerce subscriptions. I'm your host, Matt Holman, and today I'm honored to be joined by Matt Putra, the CEO of EightX. They provide financial services for e-commerce companies. I've been a fan of Matt's for a long time now, following him on social, so I'm really excited to have him on the show because one of the things that I feel like it's like that classic problem that keeps you up at night is understanding if you're profitable or not. And yet during the day, you're always worried about getting up the next landing page, launching the next ad, trying to get the next product. So finances are often an afterthought, and yet they should be the only thing that we're really worried about, or at least focusing on knowing what we can do. So So Matt, welcome to the show. Thank you.
Thank you so much for having me. I'm so excited.
Absolutely. Would you please tell us a little bit more your background, what you do at EightX,
Sure.
the types of things that would be great.
Yeah. So before I started this, I was a CFO for a private equity group. So we were buying businesses, doing investments, and kind of trying to understand as much as we could about businesses, and sort of found that I could figure stuff out fairly quickly. And then just started helping some friends, to be honest. And then one of those friends started an agency. This is Jordan West from Upgrowth. And then I followed him into the e-commerce niche, and it's been never looking back. It's been a wonderful community to be a part of. Yeah.
No, that's fantastic. And I guess now looking at our schedule, I might need to not release your episode right after Jordan's because that's just going to look like I'm just giving Upgrowth Commerce too much.
No way. Oh, that's so exciting. Awesome.
No, I love Jordan. And again, he's probably one of the people that turned me on to you just because I'm a big giver in the space. For me, social media is like, that's where I go to consume content and learn things. And so being able to follow people that are sharing things is just really great. So I would love to start with just thinking from a high level perspective. I mean, everybody talks about lifetime value, about CAC, contribution margin. Would you mind just explaining for people that are listening, whether they're new to finance or not, like some of these terms and try to understand profitability within an e-commerce business?
Yeah, sure. So let me start with what I would consider to be probably the most important thing of those that you mentioned to look at, which is contribution margin.
Okay.
Contribution margin is if you take a dollar of revenue and you remove every single variable expense. So you're removing product costs, outbound shipping, payment processing, the ad spend, the CAC, affiliate commissions, influencer stuff. So remove everything variable. Whatever's left over is your contribution margin. And I'll give you a target. So if you're an Amazon seller, the low end of that should be 15, maybe 10, but 15 is better. If you're an e-commerce seller, 20% is actually a good low end contribution margin. Now, this is for those that aren't venture funded. If you're funded, it's a bit different. But that's the most important metric to monitor because it's directly related to your profit and loss and your cash flows. That's why it just ties totally directly.
And you mentioned variable costs, so it's like that amount then goes into pay off any fixed expenses that you might be having on top of it, right?
Well, exactly.
Overhead, things like that. Right.
Yeah. Your contribution margin pays for the business essentially, right? So your salaries, your rent, your other staff. So if you don't have enough of that, you're never going to cover your fixed cost. And for those that are interested, if you want to know what your break-even point is for revenue, you take your fixed cost, say, $10,000 in rent and $10,000 in rent and $20,000 in salary, so $30,000. Divide that by your percentage contribution margin, and that'll tell you your break-even revenue.
Oh, I love that quick math. I also like to feel like a little bit an accounting class I took in college is still kind of coming through. So, okay.
100%.
Okay, that makes a lot of sense. All right. So talking about contribution margin is understanding the basically the profit you have left after all of your variable expenses, and that is the amount you use to actually fund the business.
And this is, sorry, if I might just add,
please.
This is hugely important for subscription businesses. The reason why is something we see is people going, well, my LTV of a subscriber is, 10 months times an AOV of $40 a month or twice a month, what have you, right? But and so we can pay for a subscriber on the first purchase loss because they're going to pay themselves back over time.
Right.
But it's even more important to know your contribution margin and manage that when you're a subscriber, when you have a subscription business, because if you acquire too many people at a loss, you won't be able to cover your fixed costs. So it's even more important in some ways.
That's like a cash flow question? Because like if I start acquiring like 10,000 subscribers a month, but I'm losing actually say $10, I'm actually burning 100,000. And if 100%. I don't have people existing already to cover that loss, okay.
Correct.
And then I think, please cut me back off of it. Cut me back off. No.
I think we're both really excited about this, which is
absolutely.
super fun.
Yeah, absolutely.
And so the curve of subscriber acquisition has to be managed very carefully, unless you're venture funded and you have shit tons of money. But you have to manage that curve, the acquisition rate, quite carefully, because it's exactly like we said. Some subscribers should have paid themselves off and funding the business while you're acquiring new subscribers that haven't paid themselves off yet. So you really have to watch the curve. Yeah.
Right. And then forgetting to like the incremental costs that happen with each shipment. There's still payment processing, there's still fulfillment,
100%.
There's still other aspects that go into that. So 100%. You can't just say, oh, we have 50% margin on these products. That means now 100%. We're going to get $20. Okay.
Exactly.
And then there's also the game of like playing with discounts, right? And trying to understand that. So again, bringing it back to contribution margin, I think that is the best way to think about it. And for people to understand that's happening. Look, there's fireworks going off on my screen. That is a new one. We were talking about for those of you who are just listening to the podcast, I've been dealing with iOS updates where I make hand motions on my screen and my Mac puts on balloons or thumbs up. Or that one was a firework.
I love it.
So we'll have to include that on a social post for contribution margin and fireworks.
Margin, yeah, exactly. Yeah,
fireworks, exactly. Okay, so I would love to hear from you more than just thinking about. I like to start with mistakes. Like, what are some mistakes you're seeing brands making when they're thinking about contribution margin or with subscriptions? Like you mentioned one about maybe trying to grow too fast or taking at a loss because they don't actually have the capital to be able to fund that.
Yeah. So as specific to subscription models, we work with a few, and from smaller to quite large actually. And common mistakes are being willing to buy as many customers as possible when they're when they're profitable. So even if, let's say, sorry, let me repeat that. Paying to acquire customers at a loss because the payback period is short. The trouble with that, and what we talked about before, is that if you buy too many subscribers at a loss, you're going to actually run out of money before they pay themselves back. So you can't do that. That's one. Another one I see is not managing the payback timeframe closely enough. Typical subscriber paybacks for like a product-led business would be 6 months. 3 months is great. 6 months is probably within where acquirers or strategics are going to want you to be. For SaaS, it can be more than that. Could be up to 12 in some cases. I've heard longer, but it's just tough to manage a P&L that way. Other mistakes are, there's one that I like to watch, and I don't know if everyone likes this one, but when you're a subscription business, lots of times someone will buy a product on a first time from you, and the subscription kicks in the very next month, or they buy a product and then they come back and they kick in the subscription. So if you can monitor the repeat rates from that first to second month, that's a very big indicator of what's going to happen to your business. And I say this because in almost every business I work with that does subscriptions right now, that first to second month, the repeat rate is dropping. And I don't know that we figured out why. I know that it's happening, but those things could be macroeconomic. So let's say if people are inflation's hitting your wallets, well, you're going to see less people going from the discounted trial option onto full-blown subscription. And so, but it's highly important because your CAC payback depends in large part on how many people come back, right?
Right.
So I would watch that like a hawk. And what you will find if you go back historically is you'll see periods where it bumps up for some reason. And what I want people to do always is look at those periods and what did you do differently? Was it emails? Was it a different SKU? Was it what happened? Did you call everybody for
They started subscribing to this podcast and we're figuring out how to do month 1 to 2 retention. Like that's what was happening.
exactly.
Right.
What
Okay.
else? Yeah, those are some of the bigger ones. Is payback
Are
time
there other
frames.
just bigger e-commerce ones in general when like you get a new client and you're starting to talk to them that there's just some common things? Like I feel
100%.
like for me, ones I've seen is like say on Amazon as a channel, people are actively selling or advertising products that are actually causing them to take a loss as opposed to just focusing on profitable products. What are something other maybe like just more general e-commerce mistakes you're seeing from a finance side?
Yeah, so big ones are adding fixed costs too early, right? So rent, let's say, or you're hiring a person that you don't really need, but they'd be nice. And so the general rule is that for every dollar of fixed cost for an e-commerce business, you need $4 to $5 of revenue to pay for it. And that's just to break even on it, right? So you imagine you hire someone for $5,000 a month. Well, you now need to bring in an additional 20 to $16,000 to $20,000 in revenue just to cover that person you hired, right?
Okay.
So that's one. Hiring too early, fixed costs too early. On an Amazon business, it's anywhere from, it could be $5 to $8 of revenue a month, depending on your contribution margin. So it's tough to cover fixed costs. So I see people adding way too early. Another one I see is too much inventory. I'm seeing this a lot more lately, actually, where you're if you think of inventory, you buy a product and you put it on the shelf, and you're essentially taking bags of cash and you're putting it on a shelf, and you can't use it.
I like
and
that
so then you're like,
visualization.
oh shit, I have to buy more customers. Well, the cash I have is sitting on the shelf and I can't get
Right.
it. And so what do you do? Then you have to find other sources. So buying too much inventory is one. You did mention unprofitable SKUs. I see that. Slow moving SKUs is a similar concept
Because
where
you're tying up that inventory, right?
well, 80 and we all know 80/20, right? So
Right.
be ruthless with the 20 of those SKUs. So where they don't contribute meaningfully to revenue, just cut them unless you can trace LTV meaningfully through the product purchasing path. That's the only time you should cut a shitty SKU.
Like a product
or
that
keep
doesn't
one.
sell well on its own, but when it happens to be bundled, that boosts like retention. Like people that have those two products together are 50% more likely to stick around on a subscription than somebody else, right?
Exactly.
Right.
Or let's say it's a gift that like Obvi has been doing gifting at churn points in their subscriber model. So though there are three reasons you'd keep a shitty product. One is where when they buy it for the first time, they leverage into subscriptions quickly, where it's a gift that makes sense, or I don't know what the other reason would be. But if it's not those reasons, don't keep slow turning SKUs. And what's the point? So imagine a regular piece of inventory is a bag of money on a shelf for 4 months. Well, a slow turning SKU is a bag of money on a shelf for 8 months.
Right.
Well, that's not going to help you, right?
Well,
So that's a big one.
That's actually a tip I gave on a webinar last year before Black Friday, was actually going and talking to your inventory team and looking at what's not moving, and then just use that as mystery gifts or inserts 100%. To try to create some excitement. So that's
always.
Yeah, that's definitely a good idea. Okay, let's talk more opportunity. Again, I think for those of you that are not necessarily familiar with finance or understand finance is not just tracking where money's going. That's more accounting, right?
Yeah.
Finance is really about understanding the business and where the opportunities lie. So I started with the mistakes. I'd love to hear from you some of the places or your methodology when it's understanding, hey, if we started allocating capital in this area or spending a little bit more in this area, we're going to see a profound impact on the business.
Some process opportunities, and by and large, I'm seeing the industry elevate as a whole right now, and that is the marketing spend management. And for those that, to break down what I mean, it is clearly communicating with your agency or in-house staff how much they should spend, what should they be returning to you on that spend, what is your expectation from each channel you're spending on, and giving them parameters like red, green, yellow lights. So meaning green is you're above our targeted ROAS. And so quickly, ROAS on platform is not what I care about. I care about blended ROAS.
Right.
On platform, we know is tough to manage. That's for the marketers to play with. As a CFO, CEO, I don't give a shit about that. I care about blended ROAS. Why? Because you can look at sales and ad spend and then make a calculation to the bottom line. So that's why I say blended ROAS. So tell your agency your blended ROAS target is 2, let's say, or 3. If you're anywhere above 3, spend as much money as you want because it's profitable and I know that's within target and it's fine. If you're around 3, you got to stop the ramp of spend. If you're below 3, you got to cut back until you get back to 3. And when you give very clear guidelines to an agency, it allows them more freedom to do the thing they're good at. And it gives you the confidence to know that they're going to stop when stuff's breaking. You have to watch, of course. But that's one where I see an opportunity for people to really gain is that marketing management with your P&L and cash flow in mind. And Taylor Holiday from CTC has been doing a few podcasts about this as well. Other opportunities
I'd say that, so the question that looking at from blended ROAS point, so I definitely understand that then. But if you're making like channel decisions, are you talking about taking a step back and looking at channel specific ROAS for those things?
Yes, great question. So where people run into trouble here is if they have one agency doing Facebook and one agency doing Google, because those agencies cannot independently calculate blended ROAS.
Right. No, because
each only see a platform. So then you have to do it. And you have to be clear about them with how you're going to think about it.
I guess I meant more like, say, channel as in wholesale, Amazon, my Shopify store, WooCommerce store, like that from a channel perspective.
So I would be giving people blended ROAS targets on a channel by channel basis, meaning so wholesale. Assume we don't have advertising for wholesale, so there's no spend allocated to that. Right. You don't get to use wholesale sales to boost your ecom revenue. Right? You're given a target for ecom sales divided by ecom ad spend, and then you have a blended ROAS target. For sure, I manage it independently. Now, when you go to the board, CEO level, you will explain things sometimes where you blend the channels together and you assume that there's some spillover between them. You have to figure that stuff out. But no, day to day, it's here's a channel, here's the channels, Shopify's target, wholesale's target, Amazon's target, tacos, what have you. Yeah.
Right. Okay. So then are you looking at so I'd like to hear a little bit more about what you do then specifically at EightX, like what's like an onboarding or some of the day-to-day strategy management, that kind of thing as well.
Yeah. So when someone starts with us, there's an 8-week sprint. It's pretty intensive. We dig into everything. We ask for tons of documents and we pester you for 8 weeks with all kinds of questions. But at the end of those 8 weeks, we have a financial forecast that makes sense. Sometimes it shows you that you're not making money for a bit. Sometimes it shows that you could. But we have a plan that we can manage to that we think is reasonable. And when I say we, I mean our team, because we get to see we're working with, I don't know, we've worked with 50 companies where we're currently working with like 25. And so we get to see what's working, what's not. So if you tell me my CAC is going to drop by $20 over the course of this year, we're like, no, it's probably not. So we will give you what we think is reasonable. And then from there, we want you to understand how to make operational plans. So how do we communicate with the marketing team? How do we communicate with your buyer, purchasing, inventory team, and hiring, and so on and so forth. But really, we build this model first. That tends to highlight stress points or possible breakage points within a business, and we just pick at those as they show themselves to us. With we do like a 100-point audit, and we do this financial planning thing, and we surface all these breakage points. From there, we just start to address them. So inventory could be one, cost of goods sold could be one, marketing management could be one. And if marketing management isn't one for you, we will find the other breakage point with our audits plus this process. And we just fix them one by one. And sometimes a year with us is enough. And sometimes someone wants to stay on for longer. And it just kind of depends. 6 months can be enough. It has been for some people. But we like long-term subscribers like anybody else would too.
Yeah, absolutely. Is there a target size company just for anybody listening who's interested in reaching out, like a minimum usually?
We work with brands that are doing, 2 to 80 million, and our favorites are, it's changing a little bit now, but we have processes in place to help you at that 2 to 10, and where you get like so my time is spent much at the higher level, and we're kind of moving in that direction. But we have a community that we'll talk about at some point for smaller brands, and some coaching and bookkeeping. So we do bookkeeping at any size. The reason why is because we're very good at it. We know what the big guys do too, and we'll give you very good books. And when the time comes you need a CFO, we can be there for you in that regard. And before that time comes, when you're in our ecosystem, you do get the benefit of a chat with the CFO when you need it.
Absolutely. Cool. All right.
Mm-hmm.
So yeah, talking a little bit about smaller brands. So people that are just getting started, trying to find their footing, some advice for them, and tell me more about that community you mentioned too.
Yeah. So when you're a smaller brand and you're thinking about what you're going to do, we actually don't work with a lot of startups, but generally speaking, it's not all financially driven if you're starting up. So startups, you find product market fit and find a way to sell stuff without running out of money early, right? Fine. Once you get to that 2 million, and along this path, you got to get bookkeeping in place. That's probably one of the biggest ones. I would use Finaloop. If you're small, Finaloop or Finaloop, they're fantastic for e-commerce businesses. Not always when you have a lot of wholesale, but e-commerce and Amazon, 100% recommend, because it's very affordable, and you get like real-time reconciled books, which allows you to open it up and see how you're doing week to week, day to day, which is wonderful. You do not get that from a bookkeeper typically. So bookkeeping's huge because you just need to know what the health of your business is. You can't do it if you don't have bookkeeping. The other thing that you'd want to do is daily, weekly e-com Amazon reporting. And you're going to want to understand the drivers of performance. So you don't just look at your sales and how sales have changed. You look at web visits, conversion rate, AOV, ad buys, CAC, and look at those week to week so you can understand what's flexing. And sometimes it shows you where things are breaking, but sometimes it highlights opportunity. So if your CAC is dropping, can you figure out why? If you can figure out why, can you continue doing that? Right? And it's finding, at the smaller size, it's finding those inflection points that will help you stay profitable and continue to grow. And there's a ton of fundamentals on the marketing side that people should be thinking about, landing pages and good copy and good products and all that stuff. But assuming that that's sorted from a financial perspective, the goal of your finance stack, whether it's bookkeepers or internal or fractional, is to mitigate risk and find opportunity, right? Broadly. So where there's a problem, fix it, or try to fix it, or make a plan to fix it. Where there's an opportunity arising, know quickly and double down quickly and test quickly.
Yeah. I mean, with a lot of subscription brands that I talk to or work with that are at that size, I think one of the biggest opportunities is just that it's like not realizing, say they develop 3 products and not realizing that one is a clear winner on the retention side. So that's much higher lifetime value. They're not prioritizing it over the other 2 from a marketing spend or landing page standpoint. So yeah, like paying attention to those numbers, looking at what's happening, trying to find that opportunity and or stop something that's just really obviously not working out very well. Cool. What about this community you mentioned?
Yeah, so we're launching a community on school.com. I'm sure a lot of people have heard about this from Alex Hormozy, but we believe that one of our missions is to help people at any size of business, and we know not everybody can afford to work with us directly. So we're launching a community where we'll have CFOs and financial analysts in there, day to day, week to week. We'll do AMAs. We'll be offering tools, so Google Sheet based tools that people can use in their businesses, and of course, the goal is to have a healthy community that just helps each other out and talks with each other. And but yeah, you'll see me in there, you'll see other CFOs in there, and we'll have analysts on standby in some cases to help people with things.
Fantastic. So at the time of this recording, it's about to go live, but by the time you're listening to this, it will be. So we're going to include a link to that in the show notes so that you can go join and check it out. I think one of the most impactful things is being able to get a little bit of education in those Google Sheets, right? Something somebody's already built that allows you to input your information. So like if you want to do inventory forecasting or calculating like contribution margin, like I'm assuming you're talking about those types of Google Sheets.
Oh, of course.
And that's one of the things I love about Jordan West, right, too, is like he'll create stuff, he'll create a process doc, he'll put it in a Google Sheet, and then start sharing it with everybody so they can see that as well. Cool. Matt, is there anything else you'd like to share from a finance standpoint of things, of opportunities or things that brands should be paying attention to, or maybe any macroeconomic stuff you're seeing across your clients that people should pay attention to for this year?
Yeah. Broadly, right now, everyone's goal should be to try not to use debt. And the reason I say that is because what we've seen over the past year is that the debt providers change their targets. So meaning that a provider that would have been there for a risky company that lost some money is no longer there for that business. And so I am advising people to figure out how or make a path towards being able to break even without the use of too much debt.
Okay.
Some people would grow a little bit slower if they did that. Some people would not. Some people would hire less people, and it's just, you just don't know what's going to happen. And I spoke with a founder today who has 3 friends where the bank pulled their debt out from under them, and they had to do massive layoffs. And so you just don't know right now where the economy is going, where interest rates are going. And so just really have it in mind that you can run your business without debt. That's not the enemy. That's not bad. I have a bit of debt for our agency, but we've been profitable since day one, and we're continuing to be profitable even with our use of debt. So that's sort of what I would say is when you use it is when you're already profitable and you know how you're going to use it. So
and you know how you're going to pay it back.
Well, all that too, of course. Yes.
Yeah, of course.
Yeah,
Cool.
100%.
Cool. Matt, thank you so much for coming on the show. Again, for anybody who's interested in learning more about what he's doing, I'll have a link to 8X in the show notes, as well as that community. I highly recommend giving him a follow on LinkedIn. Matt, thanks again for coming on the show.
This was awesome. Thank you so much.
Absolutely. And that's it for this week's dose. Please stay tuned next week for another dose of subscription prescription. That's it for today. Thank you for tuning in. Please subscribe so that you can get notified when new episodes come out each week on Tuesdays.